happy Casual Friday for the latest edition of the Jack and Bill Show, October the 8th of 2021. Welcome back. We were absent last Friday in the mountains of North Carolina, a place called Moravian Falls to be precise. We've had most volatile markets the last few weeks with guess we should talk about that a little bit, William, before we get into the meat of our talk. But we've had really volatile markets with the political disarray regarding the passage of the spending program, as well as bumping up against the debt ceiling. And it looks like Mitch McConnell capitulated yesterday, so that we're just going to have a temporary reprieve, I think, until December the 15th. And then we're likely going to go through all of these gyrations again.
Well, we have called this what it is. It is political theater. And I wouldn't read too much into, what these politicians are saying. It's all grandstanding. It's all about making themselves look good in front of a camera. And frankly, it does nothing to curtail the out of control spending by Congress.
Absolutely. And, we had Dennis Gartman as a financial figure that makes it on Fox and CNBC and all that. And he called last week, I read, where he said that the bull market was over. And he misses it quite regularly. I mean, I think that's pretty far from the truth. Given that the only game in town, Bill, is still the stock market with interest rates where they are. But let's talk about where we are. I was just looking at this. The S&P 500 is year to date up 18.4% on a total return basis through the close yesterday. And we just went down, 0.1% or 0.2. So we've still made, 18.2% this year in blue chip U.S. stocks. That's with all this volatility, you'd think we might be down a lot more than that from my perspective, but we're down about 3.34% from the all-time highs. So today, the big news today was the monthly job numbers came out. They were a huge disappointment. 194,000 jobs, I think, created, with the guesstimates at around 500,000 or a little bit higher. The unemployment rate did come down below 4.8%. Anything under 5 is considered full employment. So the bond market steepening on that news, though. Long yields escalating. But this has been, I was talking to a fund manager, Scott Carmack, at the Holbrook Income Fund this morning, and the bond market's really gotten disconnected from fundamentals. And the long end of the curve, which is historically given us 2 percentage points over inflation, with quantitative easing and the actions of our Federal Reserve, we haven't seen that in a long time, with the long bond yielding 2.16%, Bill, but still escalating, and it will in due time normalize. So we actually believe that some wise trades to put on take advantage of a steepening yield curve. And my point of all that is that the bond market is trading off of what oil and gas are doing these days. So I think it's interesting to note. First off, I'll say Russell and NASDAQ were down a little bit today fractionally. Dow was flat. Bond market was off. 2-year note yield is 0.34%. The 10-year, 1.6. The 30-year, pretty handily going north of 2% to 2.16 here. the very popular Dodge and Cox Income Fund that we reference, it's down 0.8% so far this year. I might add, Bill, our largest bond position is a fund that is up 7.2% so far this year. It's low duration. The bond market is negative on the year. We just saw that with the Dodge and Cox Income Fund, and we own bonds that should take advantage of higher interest rates and higher commodity prices. So silver and gold were both flat today, 2265 and 1757 an ounce. Again, the big story, West Texas Intermediate, Bill, 79.55 a barrel, up $1.25 today. Call it 1.5%. The Dow Jones Commodity Index year to date is up 28.2%. Now, what's driving most of that is crude oil. West Texas Intermediate is up 61.4% this year, not counting today. So that's probably 63% year to date. And the biggest story with the Haynesville Shale, literally under our feet, nat gas is up 116% so far this year. And I think that's a good transition into
our topic,
the main course.
Our topic of today. When you think about it, it was just 2 months ago when the White House called on OPEC to boost oil production because we were experiencing gasoline price increases. And, that kind of caught a lot of people, including ourselves, off guard because we were officially energy independent as a nation last year.
Yeah.
And then 2 months ago, we have our hands out to OPEC, asking them to increase oil production.
Bill, what do you think OPEC is going to do? I'm not going to call them what I normally call them. What is OPEC going to do when the White House tells them that they need to increase production? They're probably going to think they're hurting over there. Oh man, they shouldn't have told us that.
Yeah, they may be giving us a friendly hand gesture.
Yeah,
but we call natural gas and oil fossil fuels. That's what they are. But they're fossil fuels, but they're certainly not dead. And we are seeing this reemergence of fossil fuels driving the economic talk these days. Okay, so back in August, it was August the 11th when the White House made that announcement. Crude oil, West Texas Intermediate, was trading at $68 a barrel. The national average for gasoline in the U.S. was $3.18. Now, fast forward to today. All right, you mentioned West Texas Intermediate trading close to $80 a barrel. The national gasoline average is $3.26 a gallon. It's the highest cost in 7 years, and projections are that we'll hit $3.30 per gallon by the end of this month.
Probably today.
Maybe today.
I mean, that's only 1%.
So what is going on here? We're having huge spikes in commodities and specifically fossil fuels, oil and gas. We've had a long secular downtrend in commodities, and it does appear that we're starting to break out of that trend and that we could be entering a new or renewed super cycle in commodities. And there's a lot of reasons, why that may be. But if let's just look at fossil fuels and starting with oil, there's some interesting forecasts that are being released by investment banks, and JP Morgan is one that has been very bullish in this space. They're saying that just based on demand forecasts alone, oil could easily trade at $100 a barrel. All right, so that's a big move from here. We can look at the price of oil relative to other energy commodities, and we can infer a price projection. For example, if we look at where coal is trading right now, that would imply a price per barrel of oil of $150 to $200. All right, that's another big increase. That doesn't mean we'll see that, but it does help us quantify the potential upside for oil. We're seeing big spikes in natural gas. All right, so we've seen the natural gas price in the U.S. double this year alone. All right, we're trading at about $6.31 per MMBTU. All right, that's a doubling this year. I think we're up about 120% year over year.
Yeah, 116%.
Yeah.
Year to date.
Okay.
Right,
Year to
120
date.
year over year.
All right, well, that's nothing compared to the rest of the world. Okay, you look at Europe, they've had a 400% increase in natural gas prices year to date. They're in the UK, they're paying the equivalent of about $40 US per MMBTU. And they've even seen daily spikes of as much as 40%. That's crazy. If you want more extreme examples around the world, look at Southeast Asia, where they're paying the equivalent of $50 US per MMBTU.
Back to the rickshaw.
Yeah. It's getting so bad in Southeast Asia. I mean, they are now reevaluating liquid natural gas facilities. I mean, these are projects with long run times, very high capital cost projects, and they're canceling these projects because of the spikes in natural gas prices. Well, anything when we're talking about the economics of things, the price is the intersection of the supply and the demand curves. We are certainly seeing higher demand for fossil fuels as we're coming out of the COVID lockdowns. We're seeing economic reopenings around the world, and the need for energy will increase as a result. It does appear that COVID is peaked based on a number of metrics that are looked at. And as a result, the economy is reopening, global demand is increasing, and the forecasts are that we'll see continued energy demand increases through 2022. That's on the demand side. So what about the supply side? Well, on the supply side, we just don't have enough. We have really seen a lot of underinvestment in the oil and gas space. We've seen supply stress because of underinvestment, but also because we've seen the governments around the world invoking public policy to curtail energy production.
No drilling on federal lands and open water in some cases.
Exactly. Yes. And we like to say that the private sector knows best. And so when we have government stepping in to push public policy, it creates malinvestment. So it may make more economic sense for us to continue investing in the fossil fuel industry and utilizing the resources that we have in abundance, but instead we have taken another path.
Yeah, Bill, it makes me think about this with I think the mandate is currently to have every vehicle on the road by 2035 to be electric.
Yeah.
Or some type of alternative energy. And we don't have a power grid in place right now that could make that much electricity.
No.
And so the electricity utilization increase is going to be powered by nat gas.
Nat gas. In this country, I mean, it was largely coal-fired, and we've made the transition in the U.S. decades ago to nat gas. It's cleaner. It's very abundant. But, in China, 2/3 of their electricity generation is coal-fired. I mean, that's not fair. Why is everyone demonizing the U.S.?
Yeah, really, they've done all the climate change
Exactly.
stuff.
Exactly. But the irony is that natural gas is the transition fuel. So we
Yeah.
may end up in a carbon-free energy generation society at some point, but we still have this abundance of clean burning natural gas that makes a lot of sense right now. I mean, if we just go back in time, if we think about where we would be without fossil fuels, there would have been no industrial revolution. I mean, we would not have advanced hardly at all as a society without fossil fuels. That's just a fact. But it's the vogue thing now to demonize this industry and demonize these products which have advanced our society and really made everyone better off. We talked about natural gas, as a feedstock for power generation, but natural gas has a lot of applications, and we don't need to. We shouldn't forget the role of natural gas, not just in power production, but in heating and cooling. We're entering into seasonal issues. People sure like to have warm homes, and then the summer cool homes. That's natural gas. We use it for cooking. We use it for food supply. Natural gas is one of the major food stocks for fertilizer, and we need that fertilizer for food production. Anyway, I'm kind of going off on a tangent. But that's the situation we're in right now with fossil fuels and natural gas and oil specifically. Economic impact, it's inflationary, no question. So as we're seeing spikes in oil and gas, there is a direct inflationary impact because of it flows all through the economy, transportation, heating, cooling, food, all these things are affected by oil and gas price spikes. The other thing about it is if this is sustained, we will have slower economic growth.
Yeah, I mean, we could call that stagflation,
Mm-hmm.
Stagnating growth because of cost push, raw materials, energy, cost escalating, pushing up the prices of goods, and leaving less in the hands of middle class America.
When
For
did we
every
last see
American.
this?
Not long ago.
Yeah, it was the 1970s.
Well, that was pretty long ago.
Not for you or me. I mean, it was, the famous saying, history doesn't repeat, but it often rhymes. That was the setup in the 1970s. We were seeing slowing growth and we were experiencing commodity price inflation. And we had the long lines at the gas stations. Those were not good days. And in the UK, they're seeing that right now. The military in the United Kingdom is having to get involved with fuel distribution.
I'll ride my bicycle.
I will in the fall and spring, certainly not in the summer in Louisiana. All right, so that's the backdrop. What about investment opportunities? There's a lot of good investment opportunities to take advantage of these increases in commodity prices. We have been overweight energy stocks for some time now. We like the space. There's a lot of different ways to play this. You don't have to buy individual stocks. You can get broad, diversified sector exposure through ETFs and funds. But we do like energy. It has been a huge outperformer this year. The energy sector is up about 50% year to date. 50. And despite the year-to-date outperformance, it is still woefully underperformed the broad market over longer time periods. I think that there's still a lot of upside for energy. If you look at at the under representation of energy in the broad indexes, take the S&P 500, for example. Energy only represents 3% of that index. That's nothing. It was as high as 16% in 2008.
You know, Bill, I was mentioned previously today, I was on the phone this morning briefly with Scott Carmack, and they have a 10% weighting in high yield bonds.
Mm-hmm.
Those are lower quality, higher yielding bonds. We're not a big fan of high yield bonds, generally speaking, because I think the last I looked, the spreads over treasuries or something like 368 basis points.
You're not getting paid to take that credit risk.
When I mean, normal historically is something like 1,000 basis points, or you should get 10 or 800 basis points, 8 percentage points more over a treasury to take on that kind of credit quality risk. But Scott was pointing out that I think pretty much in its entirety, his high yield bond weighting in the portfolio is commodity backed bonds, mostly energy. So if you think about this, we live here in the oil patch in the Haynesville Shale, and a lot of these operators, I mean, it's just been everything just to keep things going. And
feast or famine.
It. But right now, with nat gas where it is, we're getting huge free cash flow. So think about this. All you income investors that don't know, where to get income from, you can buy some of these lower tier, lower perceived quality oil and gas names that are really beginning to perform. If you think energy prices are going to stay here or even go higher, you can buy these things with large coupons and deeply discounted, and earn a really terrific income, from that.
In a high yield bond space.
Yeah, exactly.
But Jack, what's another good income idea for energy?
Midstream.
Yeah.
Midstream energy. In fact, we know of now, a lot of these names, they're not for the faint of heart, or we own one that has local appeal that I think, several years ago was trading in the $14 range. And when the pandemic hit, traded all the way down to $2 and had a dividend yield that was over 30%. The dividend yield proved to be secure.
Mm-hmm.
And it's bounced back up to, it had gotten up to 10-ish. And I think this name closed today around 844, but it still has at that level, it's got a dividend yield of 9%, something 9.5%.
That's terrific.
Yeah, that's terrific. And that's typical of this space. And, that's a play on America's energy independence, as well.
So midstream, all right, that's getting the product from the well pad
to wherever it's going, to the inline user.
So we're talking pipelines for the most part, because pipelines is a much more economic way of transporting oil or gas than a truck or a train, certainly.
Yeah. I mean, most of it is, I think most is transported by rail even still today. Warren Buffett's kind of cornered a lot of that market. But we like these. It's a little bit of a pain in the neck to own a master limit partnership in any industry, because you have to wait later than usual to get your K-1 to do your income taxes, but your accountant can do that for you. But these are, this is an area that we really like.
Well, it used to be that they were all structured as MLPs, and the industry has started to shift away from that to a C Corp structure. And in that case, you don't have to deal with the K-1s.
Yeah. And of course, you can look at the integrated oil companies too. And, Chevron and ExxonMobil, these names still have a ways to go to get back to where they were.
Sure.
You've got very handsome dividend yields with them that are multiples of what the S&P 500 is paying. And they actually should perform better than an MLP, as well.
I would just say, just in general, whether you're looking at the integrated oils or midstream or other sectors of the energy space, I mean, you're getting good value. I mean, the fundamentals are there, and it's hard to find good value in this market where it seems everything is expensive. But this is an area where things are not expensive, and we are seeing improving fundamentals. So it's just, in our opinion, a great space.
Yes, we entered this year with a huge overweight in the commodities markets in varying means of doing this, and it's proven quite beneficial. And we've had significant risk reduction from traditional portfolio models with our inclusion of into the commodity space.
And we've been talking about inflation expectations and the risks of higher inflation down the road, and energy historically has proven to be a terrific hedge on rising inflation.
Yeah. Well, Bill, I think that's pretty close to what we wanted to talk about today. The throw this out there. Went downstairs to the third floor for coffee today, and I was
You needed some energy.
I needed some energy, but I was bombarded with a question about the LSU Tigers. Why
They need some energy.
Why, with their so-called high-ranked recruiting, is their offensive line so bad? Can you answer that?
Oh, you had to go there.
The coach.
And the head coach, Ed Ogeron, was an offensive line guy. So you would think.
You would think.
How important is the offensive line?
Very.
Profoundly important. Because the Tigers have not had a rushing game. It's just like drop back and throw the ball, and man, you've got everybody trying to run you down on every play.
I think they just need to buff up a little bit.
So the 3-2 LSU Tigers are invading Kentucky, who's actually 5-0 undefeated.
Yeah.
I'm hoping for a wonderful outcome here, but
that'll be a difficult game.
And we've got the Saints, the 2-2 Saints at the Washington football team. And that should be the Saints. The Saints won their two games where they were big underdogs, and then they lost two games where they were favored. So it's
since they don't have a mascot, can we just make one up for the Washington team?
The Washington team. What would we? How about the politicians?
Ooh.
Ooh. How about the liars? We better stop while we're ahead.
Oh, you're already behind.
Okay. Thank you for watching. Let us know if you have any questions or ways to participate in some of these income ideas that we talked about, or diversify your portfolio with the inclusion of energy. We actually think the trend is your friend, and this thing's likely going to keep on going. So same with the bull market is still very much intact.
Oh, yeah.
Yeah. So stay safe, make good decisions, and we'll see you next Friday.